Stocks to buy now are an ideal choice for intelligent investors because many long-term stocks are available in the Indian market with the best growth. Benjamin Graham's The Intelligent Investor can help you find the best stocks if you're confused about investing in stocks. In this video, we'll explain how you can buy 5 stocks using The Intelligent Investor. There is often a tremendous drive for financial success among those who trade stocks. Many people's fortunes have been created on the stock market. For success in the stock market, you need to work hard, keep going, and do a lot of research on the market. Stay until the end of this video because we'll discuss the 7 most important principles of Benjamin Graham that can be very helpful for you to buy those 5 important stocks from the stock market. Benjamin Graham, a professional investor and professor at Columbia University, is often called the father of value investing, security analysis, and the intelligent investor. 2 of his books are considered classics in the field and are read by millions of investors every year. These stocks are based on the information in his 2 books. These investments exhibit indicators of financial soundness despite their low PE and price-to-book ratios. In the final phases of bear markets, when the stock prices of excellent firms have been pushed down to levels below their fundamental worth, buying such stocks may be pretty profitable. Benjamin Graham's 7 value investing principles to buy stocks. Benjamin Graham, the godfather of value investing, has set the rules, and you should follow them. Benjamin Graham is remembered as one of the finest value investors ever. If you don't believe us, just ask Warren Buffett. The Intelligent Investor, also written by Benjamin Graham, is the book that your favorite stock market guru reads before turning in at night. Why should you follow Graham's The Intelligent Investor? He was one of the first to advocate for value investing in the 1920s. Unlike other investment strategies, which focus on short-term price fluctuations, value investors look at a company's long-term prospects. The idea is to invest in stocks selling at a discount, but with a high intrinsic or book value. As the firm's value will eventually correct to the level represented by its business fundamentals, this method allows you to buy stocks at a discount. Let's have a look at Benjamin Graham's 7 principles before buying 5 important stocks. Number 1. Quality rating. Stock selection can be made without seeking the highest quality firms. Values may be high for even good examples. Examining the company's S&P earnings and dividend rating is a quick and easy way to gauge its quality. According to Graham, investing in any firm with a grade of B or above is safe. A firm doesn't need to make a splash in the market or boast an extremely high quality rating to attract investors' interest. The firm must, however, have a successful track record and development potential for the future. Companies with a grade of B or better are more promising investments than those with lower rates. Number 2. Financial leverage. Only invest in businesses with reasonable debt levels, given their current assets. In times of economic uncertainty, a firm with a low debt burden is less likely to go under and more likely to be able to keep its doors open without selling off its fixed assets. Graham suggests looking for industrial companies whose debt is less than 110% of their net current assets. A value investment has total debt that is less than 1.1 times current assets. There are several online resources where one may get this information. Number 3. Company's liquidity. According to the initial point, the current ratio represents a company's solvency. Select a firm where the existing assets cover the current liabilities by at least 1.5 or 1.5%. The ratio represents a company's capacity to meet its immediate debt obligations. Number 4. Positive earnings growth. Graham never attempts to explain this away. Look for corporations that have increased their profits per share. The company's earnings over the last 5 years should be benchmarked. It's best to invest in stable businesses that have consistently grown profits. By following this rule, you can reduce your risk of losing money by only investing in the most trustworthy companies in a particular market. Number 5. Price-to-earnings ratio. Graham says investors should consider how much a company has grown over the last few years before buying it. If a corporation is profitable, it will show in its earnings per share EPS. The PE ratio compares earnings per share EPS to the current stock price of a firm. The key is finding firms to invest in with a PE of 9.0 or below. Companies whose stock prices are low compared to their earnings per share are often undervalued, which means they could still go up in price. High-growth firms and the fact that PE ratios vary by industry are not considered here. This means that you should always look at the PE ratios of the company's competitors before making a choice. Number 6. Price-to-book ratio. Investigate businesses that are selling for less than 1.2 times their book value. The price-to-book value ratio (PBV) is determined by dividing the current share price by the most recent book value per share. The worth of a corporation can be inferred from its book value. From a value investing standpoint, buying equities trading at a discount to book value makes sense. Number 7. Dividends. It's another basic idea from the financial expert, and it's easy to see why. Buffett also believes in investing in companies that improve the world. To build a passive income stream, invest in businesses that generate dividends. Stock market volatility in 2023 will be challenging to comprehend and maybe perplexing to novice investors, so familiarizing yourself with this approach now may be a good idea. Many retail investors have made mistakes that can't be fixed because they blindly followed the crowd and ignored warning signs. Since value investing is a more educated strategy, it naturally entails less danger. Before we move to the 5 stocks to buy using the Intelligent Investor, make sure to hit the thumbs up icon below to like this video. 5 stocks to buy now using the Intelligent Investor. Number 1. Housing and Urban Development Corporation. An annual revenue decline of 4% of this stock indicates room for development. A 31% pre-tax margin and an 11% return on equity are also solid figures. Technical analysis shows that the share price trades under certain critical moving averages. It must first clear these thresholds and remain above them to make real progress. The stock has solid fundamentals and relative strength, but it needs to see sustained buying activity to keep its upward trend. Number 2. Vendaya Telelinks. An annual revenue decline of negative 18% indicates a need for enhancement. In contrast, a pre-tax margin of 11% means that the business is doing well financially, and a return on equity of 9% means that the business is doing well enough. But there is room for improvement. The debt-to-equity ratio of 8% is manageable and shows that the company is in good financial shape. Technically, the stock is trading below its important moving averages. It must first eliminate and remain above certain thresholds to make any progress. Number 3. Asian Granito India. A growth in yearly sales of 5% is below par, while a pre-tax margin of 6% is satisfactory, and a return on equity ROE of 9% is acceptable but leaves room for enhancement. The debt-to-equity ratio is just 18%, which is a good indicator of financial health. Technical analysis shows that the share price trades under certain important moving averages. It must first clear these thresholds and remain above them to make real progress. Some technical indicators show that the company could be doing better than it is, but its strong earnings make it interesting to learn more about it. Number 4. Rec India. The revenue growth of 19% each year is remarkable, as are the 30% pre-tax profit and 19% return on equity. Technical analysis shows that the share price trades under certain important moving averages. It must first clear these thresholds and remain above them to make real progress. Some technical indicators show that the company isn't doing as well as it could, but its strong earnings make it interesting to learn more about. Number 5. Kalyani Steels. A pre-tax margin of 19% is fantastic, and a return on equity of 17% is outstanding. The debt-to-equity ratio of 14% is manageable and indicative of a strong financial position. Technical analysis shows that the share price trades under certain important moving averages. It must first clear these thresholds and remain above them to make real progress. The Intelligent Investor is really a gift for all stock market investors that gives direction to buy stocks by following the most effective 7 principles of Benjamin Graham. This was all for today's video to guide you on buying the 5 best stocks using the Intelligent Investor. Remember to subscribe to the channel and press the bell icon before leaving this video. Do you have any future plans for investment in the stocks? In which stocks are you planning to invest? Tell us in the comment section below because we value your feedback. We have also uploaded a video on the book The Psychology of Money on our channel, which can be very helpful to you for knowing all the secret tips to becoming rich in that book and how to become a millionaire in 2022. You can find the link to that video in the description below and in the card.